Texas Insurance Training Academy, Property and Casualty Initial Licensing, Chapter 5. We're going to be talking about property policies here in this chapter. So Chapter 5 is going to go on first-party coverages for both personal lines, which are for individual needs, and commercial lines for business needs. Some common conditions, provisions, and exclusions for property policies. The policy period is going to be effective during the initial or effective date of the policy all the way through the expiration date of the policy. Typically, these will be set at 12:01 a.m. on the effective date and end on 12:01 a.m. of the expiration date. One concept on the property policies is that you are not able to have a policy that has an insurable interest greater than your amount of ownership in the property. So you have a limit on there. If you had 3 different people that owned a property for $90,000, each of them would only be able to get $30,000 worth of insurance if they were equal owners of that property. Duties after a loss. So these are conditions for property policies that have to be met. For all property policies, you must promptly report the loss to the insurance company. If the loss is due to theft, from a peril of theft, you have to notify the police. If there is a possibility of a credit card or fund transfer company involved in the potential payout on that, you will have to notify them as well. You do have to protect the property from further damage and make reasonable repairs. This would be like trying to, after a hailstorm had created a hole in the roof, you would be able to go up there and put a tarp with some bricks holding it down so further water didn't get in there to damage more. And just as long as you've made those reasonable repairs, the insurance company will pay you back for that. It won't come out of your little limits on there. And this satisfies the condition of a duty after a loss. You must also allow the insurance company to inspect the property, and if asked by the insurance company, you must submit to an examination under oath. Always you will have to send out a signed sworn proof of loss to the insurance company within 91 days in the state of Texas. Most states are going to be 60 days. If you take a lawsuit against the insurer on a property policy, you have a time frame of 2 years and 1 day from the date of the loss. For pairs and sets for property policies, the insurer has the option to elect to either repair or replace or pay the loss of the difference in the appraised value of the set or pair. An example of this would be an insured has 12 antique dishes appraised at $1,200. One was damaged and a covered loss. The appraisal for the 11 dishes is $800. Then what would the insured's loss be? A, $100, B, $0, C, $400, or D, $200. So there's nothing special here. It's just the difference between what it was worth before and what it is worth now. $1,200 minus $800, so this would be $400. It is required for the insurance company to declare their option to either repair or replace within 30 days of the submission of the proof of loss from the insured. And loss payment is within 60 days of the proof of loss agreement or other award to the insured. Now, in the event of catastrophic losses such as hailstorms, tornadoes, hurricanes, they can't extend this out for good cause. Loss valuation is going to be generally the lesser of by the insurer, meaning that they will pay the least that they can get away with paying legally. And it's going to be what the insured property is valued at the time of the loss. Now, if you have a situation where the cost to repair or replace is more than the property's actual cash value, which we'll define here in a second, this would be defined as a total loss. And any loss that is not a total loss is defined as a partial loss. Actual cash value is going to be equal to the replacement cost of the item minus its time value depreciation. So what this means is that typically certain items will last you for 10 years. If that's the case, each year it will depreciate by 10% of its value. So when you take a calculation like this, you can take something like a television that does actually decrease in value for replacement costs over time, because the new models come out and the original technology that was there becomes less expensive because it's more obsolete. So an example would be if you bought a 60-inch TV for $3,000 5 years ago, that same TV only costs $1,000 to replace today. Not the updated model, but the original model. And we see this all the time. On a 10-year life expectancy, it will decrease 10% per year. There is no standard on these necessarily, but 10 years is kind of a good rule of thumb for a lot of personal property. All right, so you would expect the TV to last you 10 years. So therefore, it's going to lose 10% of its value every year. So if you look at the actual cash value for that TV, as far as insurance would look at it, it would be $1,000 for the replacement cost, which is how much it costs to replace today, minus 50% for the depreciation, which means the actual cash value of that TV is only going to be $500. Now, the same type of thing can happen when the value goes up. In this case, this is something we have seen lately for furniture. A sofa that was purchased for $3,000 5 years ago, now that same sofa costs $5,000 to replace. This couch is supposed to have the same amount of life expectancy as the TV, so 10 years, so it'll depreciate at 10% per year. So if you look at the actual cash value of this couch, what we're looking at is $5,000 is today's replacement cost minus the 50% depreciation. So therefore, the couch actual cash value would be $2,500 for insurance purposes. Understand replacement cost is defined as the cost to replace damaged property with like, kind, and quality at today's price, today's cost, not the original cost. Technically, or this would be contrary to the principle of indemnity, but that doesn't mean that the insurance companies don't use it all the time because this is what their customers are asking for. They kind of bake it into the pricing and the premium so that they can do that. Different types of valuations are going to be possibly available on a property policy. Market value is one. But it is extremely rarely used, and the reason for that is that it sets up an argument from the beginning. It's the value that a willing buyer would pay at the time of the loss. So this one typically is going to be very difficult to do, and you're already probably going to go into an appraisal type situation because you're already not agreeing on the type of the pricing for it. Agreed value, this is typically used in commercial property policies. This allows for a suspension of the insurance to value clause using a statement of values. Basically what this means is, as you can have an expedited process to get commercial property without having to go get an appraisal on a building first, for example, you wouldn't necessarily know the exact value of it, so it's not going to have a requirement in there, and we're going to talk about the insurance to value clause here in a minute. But typically it's going to be at least 80% of the value of the property. So they suspend that until they've actually received any kind of an appraisal or update the policy by doing an audit, which is where we talked about deposit premium and audit previously. Stated value, this is usually used for special situations like unique, antique, or customized automobiles. The stated value is used because it has a method of how they compute the premium. It's not necessarily how they're going to pay out losses there, because these situations have difficult to evaluate actual cash value, because there can be a high variance in the cost of replacement parts or labor to work on certain things, depending on what type of situation you're dealing with. And then salvage value is going to be used in a situation where there is a total loss of the vehicle. In this case, salvage value is going to be automatically applied in there unless you ask for it to not be. because what will happen is they'll give you not only the actual cash value of the vehicle, but they'll add in the amount of money that they can recoup from scrapping out the remaining vehicle parts and pieces, so that they can keep the greatest amount of value there, right? So in this case, you would have to surrender the title so that they can do that. Otherwise, you can keep the title, get a lesser payment, and you would have to then be responsible for doing the scrapping out yourself. A deductible, this is going to be something that I hope that everybody probably already knows at this point, but a deductible is the most of the insurers obligated to pay is everything minus the deductible. So sometimes the deductible is called a retention. And the higher the deductible means that you're going to have a lower premium, and you're also going to have a high premium, typically with a lower deductible.